So technical analysis or charting means looking at the past data, okay, past trend. You try to project the future. We do this in our day-to-day life also. If I have to project the future, we have to look at the past data. If I have to go to Kashmir, for example, although I don't intend to do right now, and I am going in the month of December, I will look at the temperature in December of last few years to get an idea what is the weather, what is the temperature. Accordingly I will plan. So what I am doing, I am using the past data and trying to guess what will happen in December this year. Okay, that is charting and technical analysis. We do it in our day-to-day life. You can do it in the stock market also. So there are two types of people. One who believes that technical analysis can help them to make projection about future. So they have a strong belief that carefully analyzing the past performance, one can predict the future movement of share prices. So they are devotees. They are like bhakt, devotee who believe in God. Okay, and they believe that with lot of analysis, persistence, lot of carefully doing calculations, I can project what will happen in the coming years. And of course there are people who believe on the other side, who are random walk theory devotees, that stock market behaves like a drunkard man. Every past data is just a statistics, and every next day is independent of what happens in the past. Past cannot be used to make projection about the future movement. However, because it is in our syllabus briefly, we'll just have a look at it, and if you are more interested, this book or your ICI study material is not good, not sufficient. You have to do some more courses, some more learning. So don't spend too much time on this. From exam point of view, list asked area. Let us begin. Technical analysis is based on the premise that there are persistent and recurring patterns of price movement which can be identified by analyzing the market data. So by looking at the past data, we can get an idea as to where the market will move. The technical analysis is concerned with the fundamental strength and weakness of a company or an industry. So these people will also look at the strength and weakness of an industry, but his more focus is on understanding the price behavior, the past behavior of the share prices or any indices. So what are the two basic questions a technical analyst will try to answer? First question is there a discernible trend in the price? Can we see a trend in the price? Can we see a trend in the price? That is what they will do. So they will do analysis of lot of charts. If you watch news channel, especially the finance news channel, throughout the day some charts will keep on appearing on the screen, and these people, these technical analyst people, they will say, see, this is the price where it has gone high, this is support, this is resistance, here there is a breakout, and you just keep listening to them without understanding, and then you change your channel to MTV, right? That is more understandable. But then if you learn this chapter, you can understand those charts, you can understand what those anchors are trying to explain to you. And if suppose there is a trend, then are there indications that trend would reverse? Are there indications that trend would reverse? Can you predict the reversal of the trend, or do you believe that the trend will continue? Check whether trend exists. Will the trend reverse or not? That is what technical analysts do. First thing we will study is chart patterns. As I said, we are not going into too much of detail considering the time constraint and the requirement of the syllabus. Too much of in-depth study here is not required. Wherever it was required, we had given a lot of time for those topics. So first we will see chart patterns. These chart patterns or graphs are used to predict the market movement. The basic concept underlying the chart analysis is that you will be able to check whether the trend is there or not. Is there any trend? Is it a rising trend or a falling trend? Then you will be able to understand the resistance between volume and trend. Volume means the number of shares bought and sold, and trend means going up or down. So we will discuss this paragraph later, how the volume and trend are analyzed, what do they signify, and then we will understand resistance and support level. Most analysts use chart at times as a method of keeping track on the price movement of particular share or of the market as a whole. So even you must be using this chart analysis in case if you are investing in the share. Every day you must be checking when you open your computer or mobile. Let us say you have invested in the shares of Reliance Industries. So you will see they will show you some chart like this on your mobile screen, and they will write down price at 9:15, 12:30, then 2 o'clock, and finally 3:30. So what you are doing, how the price has moved during the day. And nowadays if you want to know the price movement for 1 year, that is also available, 5 year, that is also available, 1 month. So looking at these charts, graphs, you get the trend of the share price movement for that period, right? Sometime you can see, if you look at the long term charts, you can see the trend. So now we'll discuss few charts. The first one is called line chart. This consists of connecting the closing price of the share. So if you just take your mobile phone and type there Reliance share price today, and then probably you will find on your mobile, just try if you can, a chart will appear and it will show today the graph like this. This is not Reliance share price, this is just a rough idea how the line charts look like. They will just connect all the prices for a period. Like in this example, October 24 to October 26, this is how the price have moved. So they connect the closing price of the share. This is very common, which you will see normally. It also appears on your television channel screen on a daily basis if you watch some financial news program like NDTV Profit or Z Business, like that. And then you can also get average price if you want. It shows the price movement over a period of month or probably years also. So nowadays you have options, you can click what you want, 1 day, 1 month, 1 year, 5 year, year to date, and immediately you will get on your screen the price movement of that period. So this is called line chart. It gives you a quick idea as to the price trend over a period of time. So this connects the closing prices or average prices. but there is a little improvement of this, that is bar chart. So here what they do, they will take the price of a day, what is the lowest price, what was the highest price, and the closing price. So there will be a small tick indicating this was the closing price of that share and this was the highest price and this was the lowest price. So you get three information here: highest price, lowest price, closing price. So this is, you can draw if you want. Those who are interested, first you draw this line chart in your notebook or in your book, wherever you want. A rough line chart you can draw. Then bar chart, where you will have to draw lines. You don't have to draw so many lines. You can just draw some few lines like 1, 2, 3, 4, 5, and then you just have to put a tick here. That is enough. The tick mark indicates closing price. The lowest point is the lowest price of that day. The highest point is the highest price of that day. That is called bar chart. So it gives you lowest, highest and closing price. And this also gives you over a period of time what is the trend, right? In bar chart, prices are indicated on the chart's vertical axis and the time on the horizontal axis. So this is your price and time. Then vertical part of the line shows the high and the low prices at which the stocks are traded or the market moves. So this line will give you highest and lowest price. It also gives you the closing price. By a small tick, it will give you whether the closing price was closer to lowest price or the highest price. So that gives you an idea how much the price fluctuated during the day and where it ended. So that is how we draw bar charts. So please draw this diagram, but you don't have to draw so much, just few lines are enough. Please draw the diagram. Take a scale. And in case if you want to learn more about the diagram, there are a lot of websites on NSE website, National Stock Exchange, and there are other websites like investing.com where they have got many such diagrams, charts, patterns. You just name the company there. You want the period, what kind of chart they want, they will present it to you, right? Now we'll come to third one called point and finger charting. Point and finger charting, P and F. So you have to look at this diagram also here, which is already printed in your book, and the note also will read parallelly. In this chart there is no time scale and only price movements are plotted. There is no time scale as such. So I will not write day 1, day 2, day 3, day 4, or I will not write January, February, March like that. We will just write time. As long as the share prices are moving up, we will write on the same box by writing a cross symbol indicating that the prices have continuously gone up, and we'll write in the same you can say column. But the moment the price falls, I will change to go to the next column and draw circles or zeros, whatever you call. As long as the price is falling, we will keep drawing in the same column. Again, when the price will start going up, I will go to the next column and start drawing this cross sign till the price is continuously going up, and when the price again falls, I'll go to the next column and draw zeros, and this way point and figure chart is drawn. When it falls, a circle is plotted in the next column, and this continues downward while the price continues to fall. When it rises again, you can see next column again it rises. A new vertical line of crosses is plotted in the next column, and so on. I will ask you to add 2 more points. If they ask you a theory question, it will be point and figure charting. So then you can add 2 more points, draw this diagram. Write down, it does not plot the volume traded. It does not plot the volume traded. It does not plot the volume traded. So you cannot see the volume here, only whether the price is going up or down. And second thing you write, P and F charts are one of the best charting techniques. P and F charts are one of the best charting techniques for accurately determining entry and exit signals. For accurately determining the entry and exit signals. So the moment you go to the next column, it means the prices are now going to fall for some time, so you can sell. And the moment you go to the again third column, it means now the prices are going to go up, so the signal would be to buy. So you can use point and figure charting to accurately determine whether the prices are going to go up or going to fall further. So this was about point and figure charting. Take out your notebook. We will solve a small question on point and figure charting. Chances that this question will be asked is very less, but at least let us do some practice. Consider the following data. Write in the notebook. Consider the following data, and there are 10 days. You can see there are 10 days, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And closing price. Closing price 512, 535, 539, 522, 510, 502, 527, 542, 545 and 512. Taking a grid size of rupees 10, plot this data on point and figure chart. Plot this data on point and figure chart. Assume that the first price was a rise. Assume that the first price was a rise as compared to the previous day. First price was a rise as compared to the previous day, which means that you will start with a cross. As long as the price is rising, you will write in the same column. If the price falls, you will shift to the next column, and you will keep a gap of 10 rupees in the diagram. So this is the diagram. Please write down. Start with maybe 500 you can start with, because the lowest number is 502 and the highest number is 545. So maybe you can draw 500 here, 510, 520, 530, 540, 550. Up to 550 I think will be enough. So draw y-axis, x-axis. On x-axis write down time, y-axis security price. First number is 512. So 512 will come in this grid. Draw these grids. Okay. Put a cross mark here because the price was rising. Then next is 535. So this is 535. maybe this is 535 here, and then 539. So actually there will be two cross marks in this grid, XX cross mark. Then 522. So 522, this is 522. 510. So this is somewhere here 510. 502, this is 502. 527, this is 527. 542, so this is 542 and 545. So maybe there can be two X cross mark in this grid, and then 512, again it will be here 0. So this way you have to draw. Roughly you draw, don't worry much. Okay, so this is point and finger chart. Come to the next paragraph, market indicators. What are market indicators? It helps us to know whether the market is going up or going down. A major indicator of the breadth of the market is the volume of transaction. So one can look at the volume. Volume is the number of shares bought or sold. By looking at the volume, we can get an idea where the market is heading. When interpreted in conjunction with index or price, it provides useful clues on how the market would behave in the near future. Volume and the trend in price, read them together, that will give you a very good idea where the market is heading. So now see in the next 4 lines, which is written in your book, a rising index, that means the index or the price is rising and the volume is also rising. So if you find that index is rising and the quantity bought or sold is also rising, so in that case it signals a buy. It signals a buy and it reflects an unsatisfied demand in the market. Rising index, rising volume means people are still waiting for buying. There is an unsatisfied demand, so you can buy because the prices are expected to rise. A falling market is falling and the volume is also increasing. That's a signal of selling, because more and more people are now interested in selling, so the prices are expected to fall further. Falling market and increasing volume is a signal of sale, and a rising market with decreasing volume. The market is rising but the volume is decreasing, so it is a bull market, but it means now the bull phase is about to come to an end because the volumes are declining. So bull phase is running out of the steam now, it is about to come to an end. The continuous bull phase is going to come to an end, and the falling market with dwindling volume. Market is falling, volume is also decreasing. It means the bear market is now about to come to an end. So market is becoming breathless. So now it is time the bear market will come to an end. The market will stop falling now. So these are the 4 market indicators. Another important understanding about stock market is understanding the support and the resistance level. Support and resistance level, there is a diagram printed in your book below. You will find there is a resistance level at the top and there is a support level below. That means the market will try to reach higher and higher point, but there is a resistance level and beyond which it is not able to rise. The moment the price will reach that upper limit, more and more people would try to do profit booking, they will sell, and the prices will not further go above the resistance level. Similarly, if the prices fall, there will be a support level. At support level, people know now it has reached the lower price, and then again the buying activity will start. So the prices are not falling below the support level. So normally the market will move between the support and the resistance level. However, it is possible that the support level or resistance level can be breached also. So when it is going to get breached in the long run, again a new resistance level and a new support level will be created. So now you can write a note on resistance level and support level like this. Resistance level is a price level to which the stock or the market rises and then falls from rapidly. So market will reach that number, but then it will not be able to breach that. It will not be able to cross that. Again it will fall. Again it will try to reach. Again it will fall. So it is a price level to which the market rallies repeatedly but cannot break through. At this level, selling increases, which causes the price to fall. So people do profit booking, what we call profit booking, because now people believe that prices have reached the maximum, so it is high time we sell it and book the profit. So selling pressure goes up, because of that the prices again fall, and support level is the lower price. Normally prices will not fall below the support level, because at support level people will believe that now it has reached its lowest price, let us buy. So a support level is a price level to which a stock or the market prices falls or bottom out repeatedly and then bounces up again. Demand for the stock increases as the price approaches a support level. So as the price reaches support level, means it has gone down to its bottom level, so it is the good time to buy. So buying pressure will go up, demand will go up, and therefore the price will again rise. So buying or the demand pressure supports the price of the stock from falling below the support level. Is it possible that these levels will be breached? Yes, nothing is permanent. So it is possible some very bad news come, a news about a scam comes, and then the company share price can even go down below the support level also. Or if a company discovers a vaccine which they know will be in huge demand for next few years, the resistance level will be breached and a new upper limit will be set. So a breach of these levels indicate a distinct departure from the status quo and an attempt to set the near levels. So look at this diagram printed in your book, resistance and support level diagram. This x-axis represents time, this y-axis represents share price or security price. The upper line is called resistance level. So if the share prices touch this resistance level, the signal is to sell. So just add here sell signal, because now the prices will fall from this level, and if the prices touch this support level, it is a buy signal. It is a buy signal because now it has reached its rock bottom price and it is the time to buy. So write here buy signal. Next important and interesting discussion is interpreting price pattern. There are many price patterns. If you are really interested, you can study on your own, or you can join some technical chart analysis course where they will teach you number of price patterns. But as I said, our syllabus does not go into details of all this technical analysis. So just few price patterns are there in the syllabus. We'll have a quick look at it. Numerous price patterns have been developed to interpret price patterns. So by looking at the price patterns, you get an idea whether the market is now going to go up or whether the market is going to fall. So some of them we will discuss, and I request you to read more books. You can do some research on Google or YouTube. You will get more and more price patterns there. But for exam purpose, this is not very important. As I said, in last 20 years, I have not seen, I think, even one question on price pattern. So first is channel. Just look at the diagram. You will find that the price is moving in a channel. That means these are traveling between two parallel lines. So that is why it is called channel, and it can be an upward channel showing the tendency of the price to rise, or it can be a downward channel showing the tendency of the price to fall. So that is, it's called channel. A series of uniformly changing tops and bottoms. Uniformly changing. You can see the diagram. It goes up, then again it falls, goes up, falls. So almost with equal magnitude gives rise to a channel formation. Of course, exactly like this is very difficult in practical world. Very difficult. I cannot, we will not see exactly moving up and down in equal amount, but sometimes, very rarely, it may be possible. A downward sloping channel would indicate declining prices. So if you come across this kind of diagram, then you can understand that the prices are falling. If you come across this upward channel, then it means the prices are showing a rising trend in the long run. So upward channel, if you see, you buy, and downward channel when you see, you can sell.